Welcome everyone to Breakwave Day. We hope you enjoy our event.
Hello and welcome to our Breakwave Day 2025. I'm John Kartsonas, founder and managing partner of Breakwave Advisors. For the fifth year in a row, Breakwave Day is here to provide views and opinions in the dry bulk and tanker shipping markets from experts across the globe during our 2-hour live event. 2025 has been a remarkable year for shipping. Tanker rates have seen one of the steepest rallies in decades, while dry bulk has experienced a solid year despite a rather dim macro environment for trade. For an industry that usually thrives during geopolitical uncertainty, shipping remains an uncorrelated space for investors, and the past year has definitely been a testament to that. As we look into 2026, opportunities and uncertainty remains particularly high. Global growth is poised to decelerate somewhat. Uncertainty around the Russia-Ukraine war is abundant, and trade wars are still shaping global commodity flows. Both tankers and dry bulk look particularly strong as we enter the new year, and there is little indication of an imminent inflection point. Yet one should always remember the cyclical nature of the industry and be aware of the risk involved. Our event aims at not predicting the future, which of course is impossible, but at providing views and opinions from the people who focus daily on shipping, so each one of us can form his or her own opinions, whether such arguments are valid, and how to react to unexpected developments when they arise. After all, in commodity shipping, no one has any superior information, and shipping is one of the most even play fields in the investment world. Over the next 2 hours, you are going to hear views and opinions related to dry bulk and tankers from some of the brightest minds in the industry. Today's event, combined with our regular publications and frequent updates on our Insights webpage, should hopefully continue to add value to the investment process of such an exciting industry for all of us to invest and trade. Now, before we begin, I want to mention that this is a live event as always, and I would like to apologize in advance for any mishaps during this broadcast, which includes presenters and participants from all around the globe. So now, with no further delay, I would like to introduce our first segment that focuses on the current state of the dry bulk market, as well as the outlook for the years ahead. We're very excited again to have with us our first presenter. As the global head of dry bulk research at Braemar, Langston has been providing some of the highest quality research in the industry. If you invest in shipping, you must follow Braemar and listen to their views and opinions. As one of the largest shipbrokers in the world, Braemar receives first-hand valuable information, which in turn they manage to convert to actionable research. And with that, I would like to go to London and introduce Derek from Braemar to provide us with his views on the space and his outlook for next year. Good afternoon, Derek from New York. The floor is yours, so please go ahead with your presentation.
Thank you, John, and welcome everyone. It's great to be here again. As John mentioned, I was here last year, Breakwave Day, and we were assessing, as well as the usual, supply and demand drivers in the dry bulk market, such as China's coal and iron ore import demand, fleet supply growth, and anticipated fall in grain trade. As well as that, we discussed some of the other issues that were affecting us at the time, avoidance of the Red Sea, for example. And on the eve of a new US administration, we also raised the prospect of tariffs and potentially trade wars. So as we stand today, this week, we've got the highest dry bulk freight market for almost 2 years. The question is, what happened in 2025? What drove the market in 2025? And what can we expect in 2026? So starting first of all with the freight market position. This is a longer term context. We're using the Baltic Exchange Dry Bulk Index, a basket of rates looking at the dry bulk market. This is an indicator, index point, doesn't refer to any dollar value. But on this chart here, you can see really over the last 2 decades, we've had some fairly wild swings. First of all, there was the China import boom, 2007, 2008, at a time of fleet undersupply. We've had China's stimulus in 2009, 2010. Then we had a quieter few years, and then back in the COVID time with the disruptions caused by quarantining, various fleet inefficiencies, some container products moving into the dry bulk space, the market picked up again. And as we speak this week, we're at the highest level for almost 2 years. So what's been driving that? Well, of course, the big picture can't really get much further than China. When we're looking at, for example, crude steel production, which of course very relevant because the biggest cargo being iron ore imports into China. China's position, of course, is unparalleled. Over half of the world's crude steel production is produced in China. About 75% of iron ore imports go into China. It's higher for some other commodities such as bauxite. We're talking about almost 90% of bauxite going in there. So it's interesting to see there with China the last few years, after a peak in 2020, crude steel production easing slowly from that peak. At the same time, if you look on the chart on the right-hand side there, you can see that growth, that tremendous growth in iron ore imports from 2000, picking up from about 2009 onwards with coal imports, then most recently bauxite and other ores and concentrates. So this really has been beneficial to all sectors of the dry bulk market. Looking at fleet supply side at the same time, the dry bulk market, as you can see from the previous slides, did struggle a bit with oversupply through the 2010s. But really in recent years there, you've seen quite a steady flow. If you're looking at the whole dry bulk order book combined, quite a steady amount of new building deliveries, steady fleet growth at just under 3% currently. And as you can see there, the green is the new building additions that we're seeing coming onto the market. The black is the deletions, so that's mainly demolition, scrapping. As you can see in the last few years, actually relatively little scrapping, such as the confidence in the market in the next few years. So then looking at the current state of the market, and the first slide here looking at Cape sizes, the largest segment, based on a 180,000 deadweight bulker. Now this is very much linked with the iron ore, bauxite trades, as well as some coal. And you can see there what we've got in 2025 in red is a slow start to the year. But as we can see in the last few weeks, it's been rising, getting up higher. Now, this chart was submitted to Breakwave only 2 days ago, but we've seen in the last, yesterday we had a move of $6,000 a day in the market. So now you have to imagine that average earnings there for a Cape size being $44,000 a day. So you can see there in the past we've had these kind of upward moves. And with the Cape size sector, I think it's important here to say, yes, we do have more cargo arriving at various points in the Atlantic market, but also it's a question of fleet supply. Fleet supply has been relatively tight. We seem to have got to a bit of a tipping point. And that's one of the characteristics of the Cape size market. When you do, almost in a case where there's so much cargo coming onto the market, the fleet supply isn't enough, then you can almost be sort of chasing the market higher, chasing ships higher. So this is what we're seeing really at the moment. Some of that is structural because with the Atlantic market, you have fewer ships doing transatlantic trades. You have more ships leaving the Atlantic doing long haul trips into the Pacific, and actually fewer vessels coming in with cargo back into the Atlantic. So structurally, it's feeling fairly tight. If we look at the Panamax market, this is a one size down here, an 82,000 deadweight vessel. Again, we've got 2025 in red. What I want to highlight here is the comparison with 2024 in green. You can see there for the first half of the year, quite a bit of underperformance. And then from about July onwards, quite a dramatic reversal. The red starts to outperform the green, and we see a stronger Panamax market through the second half of the year. If we look at the smaller sizes, the geared bulker sizes, the Supramaxes of 58,000 deadweight, the handy sizes of 38,000 deadweight, we're looking at those ones comparatively. Yes, you can see there that the second half of the year is firmer than the first half. And also currently, the red is there again, outperforming the green. So significant outperformance on recent years. So what then? We've looked at the market. What then is driving? The first point we want to mention is that grain trade decline that was flagged up a year ago did materialize. But it was really, you could see in the first half of the year, annual falls, but the second half of the year was quite a noticeable pickup. Now, this helped the Panamax and the geared bulker sizes. You can also see that, yeah, there's been a pickup as well, but there's also one sort of caveat to that, and that, of course, is US soybean sales to China. One of the manifestations of the tariffs and the trade discussions that have been a big feature of 2025. Currently, the US, after meeting the Chinese counterparts at the end of October, there was an agreement that on the US side was reported as 12 million tons of soybeans sold into China. We're starting to see vessels arriving to take those soybeans into China, but at the moment progress is slow and we're well behind the levels that we've seen previously. We've, as I mentioned, falling steel production in China, and that's actually with more steel exports being shipped overseas to external markets. Panamaxes have seen an expanding share of coal, and with, mentioned, the China's coal imports, which corrected downwards in the first half of the year. There was a sudden upturn from July, August onwards. And this was really as the fundamentals in China changed. Domestic coal production fell year on year for the first time in 18 months. Part of it was weather, part of it was mined checks for safety and environmental reasons. At the same time, thermal power generation really relies on coal, also increased. So we had a bit of a shift there. That had a big effect, particularly on the Panamax market, leading to a stronger second half than first. For the largest sizes, capes, the trade expansion from the long-haul Atlantic to Pacific voyages been driven by Brazil's iron ore and also by Guinea's supply of bauxite for the aluminium market. We've seen minor bulk trade growth, particularly strong for fertilizers, ores and concentrates such as nickel ore, manganese ore, cement and clinker has been positive as well. So there's been some benefit for smaller sizes too. But also a key characteristic of 2025 has been noise. All of this been surrounding the announcement of tariffs, port fees, military threats, and possible peace deals that would affect, for example, trade going through the Red Sea and potentially Black Sea as well. So a couple of examples on that theme of trade protectionism. What we have here is China's imports of soybean, particularly important for long-haul Panamax business from the Atlantic to the Pacific. We have here Brazil's share in green, the main supplier, and this last year has been particularly strong for Brazil, as was expected. US, as you can see here, is barely registering at the moment, which is quite unlike previous years, but also note there that Argentina has been shipping more soybeans into China as well. So in terms of that, really, you can see there that from a Panamax perspective, these volumes have been fairly strong, even without that influence of the US. Another area, of course, where we've seen talking about protectionism, talking about tariffs. Yes, there has been a bit of an easing more recently in US steel imports. But we would argue that the big story regarding trade protectionism is about China's steel exports and keeping Chinese steel out. There have been a number of measures against Chinese steel products. They have been successful on particular products, but China's also been quite adept at changing. So we're seeing more semi-finished steel, for example, from China entering the market that hasn't been affected. And what this chart shows here is that it is actually easier said than done to keep China's try and keep China's steel out of the market through protectionism. It also shows you how widespread China's steel exports have been. For us, the key change that would have to be required for China's steel exports to fall would be a move on the Chinese side to start to control some of the exported flow. For coal, two main drivers in the world, India and China, had quite a divergent picture. The red here for China shows this volatility, monthly fluctuations that we've had on coal. So you can see there in the red in 2025, that downward pull, and then from about the Q3 onwards, that upward movement again in terms of imports into China. And at the same time, Panamaxes have been expanding the share of coal. Some of this is to do with practical reasons, berthing restrictions, not really preferring a smaller cargo size. Some of it's also to do with some of the vessel operators preferring the flexibility of a Panamax. So we're seeing Capes not doing as much coal business as before. Sometimes that's to do with countries such as Colombia. They're not as shipping as much into Europe or Asia as they used to on the Cape sizes. And for Cape sizes, the two big drivers, mentioned Colombia being a bit of a negative there, but the two big drivers there have been Guinea as bauxite, predominantly into China. As you can see there, that's on the Chinese imports from Guinea on the left-hand side. And then you have, after the terrible dam disaster that led to mining suspensions in Brazil, we now have some fairly solid and strong growth from Brazil's iron ore exports. Most of these are China facing, so that has a bigger impact on the market. So what then is the outlook? So taking the seaborne dry bulk trade growth that we have on the right-hand side, you can see there that we did see that slowing, and a lot of that does owe to coal trade being lower, and also the effects I mentioned on grain trade, particularly in the first half of the year. Back in 2021, COVID-related fleet inefficiencies played a massive role in supporting the freight market. We would say last year that bauxite and iron ore imports, they were positive, but we have those constraints, particularly in the first half of the year. And we'll see that in 2026, we have that potential for faster trade growth. And in particular, we talk about a rebound in grain and also the prospects for more bauxite exports and also iron ore exports, in particular with a new line starting here also in Guinea. We've just seen the first shipment of iron ore from Simandou, a project that once it hits its realization will be 120 million tons. Now this is not just on top of the market, this really is very high grade iron ore. There will be some displacement from ore elsewhere in the world, but of course it's going to be mainly focusing on the Capesize market. Its geographical position with clear focus on China means it's extremely strong. Looking at the fleet growth charts that we have on the left-hand side, the outlook for next year, you can see there that there is an increase in the number of new building deliveries that we expect next year. These are particularly focused in the Panamax sector. So overall, we're looking at, say, 3.5% growth. That's what it looks like to us at the moment. We would, of course, say that if you're looking at those that have been investing in the Capesize sector, for example, they'll be looking at the chart on the right-hand side and saying, yeah, well, we look at that. We have their growth of, say, 1.5%, 2% growth far slower. That is the more kind of optimistic case there for Capesizes. For the smaller sizes, you do have faster growth we've seen this year and also next year. So what then are the risks to the outlook? Well, first of all, for Capesize demand, we really would focus on those twin drivers of iron ore and bauxite from West Africa. There has been an immense amount of speculation about how much ore can be moved, how much bauxite and iron ore can be moved from Guinea, from this huge Simandou project next year. The ramp-up time is expected to be around 30 months. And as I mentioned, we've just seen the first ore shipment being made. Now, of course, there is no question that there is a market for this. A huge amount of capital expenditure has gone. We have a huge supply chain, 600-kilometre long railway. The mine, of course, the grade of ore is very high quality. It has a place in the future of mining, especially if you're looking at green steel, where you're looking at higher grade of ore, but also as well could be blended with lower grades to create a more consistent project. So that is definitely significant. There is, of course, with this, there is, of course, risk. This is a brand new supply chain. And from speaking to different clients of ours around the market, I've accidentally been doing a bit of an unofficial survey on the market. And I can say there that the difference of opinion between the high case and the low case for 2026, in terms of how much iron ore can be shipped from Simandou, the variance of opinion, the spread, is 25 million tonnes, which is quite a big spread as well. Now, Simandou is not the only new project. There are others in terms of bauxite and iron ore also from West Africa, but it is the largest, so it's the highest profile. So that won't be one of the key prospects for the Capesize market next year. The Panamaxes, again, we would say that China's coal import appetite can surprise in the upside, downside. And again, we're kind of looking really at other factors such as China's steel exports, big factor in 2024 in terms of the demand for smaller vessels, for geared bulkers, especially some of those longer haul trades from China and going as far into the Atlantic. Can they remain historically high? We would say that really probably is in the hands of China's policymakers, as well as those trying to keep China's steel exports out. There is, of course, political risk. Now that can be positive as well as negative. For example, the 50% tariff being placed by the US on India, for example, that may have a detrimental effect on India's economy, say in a year's time. But if there were to be agreement, then that could be something that could act as a boost for the economy there as well. So really, all in all, when we're looking at these trade drivers, there has been a lot of noise, yes, but still we're in a case where some of the traditional supply and demand drivers mustn't be overlooked. New building deliveries, as we mentioned, for geared bulkers expected to be similar, fairly low for the Capesizes, but Panamax new building deliveries to jump next year. Now this might start to weigh on the create a bit of an oversupply of ships potentially, depending really on the grain and coal trade strength. Will we get a normalization of the Red Sea and the Black Sea? Now, for example, if we see the Red Sea normalize, our calculations at Braemar is that by more vessels taking that route, we would see about 0.7 to 0.8% of the fleet capacity reintroduced into the sector. So that would be a bit of a negative for the market. Black Sea normalization, well, this is potentially that would maybe lead to more smoother outflows of products, but reconstruction as well in the longer term, that's something else that's being discussed that may stimulate more shipments of steels and cement building products. And finally, sometimes it's more interesting. It's the ships that are doing nothing rather than ships that are doing something. So when we have, for example, at the moment, we have a relatively high year for dry docking because a lot of ships are due to have special survey. And we estimate this has taken out about 2.3% of carrying capacity out of the fleet, as opposed to 1.8% last year. So the fleet supply is tightened up last year by about 0.5 percentage point globally. So fairly significant. And we all know as well, particularly with the shipping markets, it's the unexpected that comes in to the market. This year we do, for example, unexpected bouts of port congestion. Think in East Coast Australia in June with Panamaxes, back in March in Guinea with Capesizes. If that, those bottlenecks can and do occur and are very important in moving up the market balance. So thank you very much for the presentation, and yeah, pass myself back on to John.
No, thank you, Derek. It's interesting that I noticed on your risk page like 3 out of the 7 risks have to do with politics and geopolitics, which is something that we haven't seen in a while in shipping. But 2 quick questions for you. First of all, on the U.S. Soybean sales to China, you said you haven't seen much yet. Is that correct? Do you think that we're running behind? Do you think that actually we're not going to see the amounts that was agreed?
Yeah, I mean, at the moment, typically, if you're looking at the beginning of December, you normally have a few months of shipments between the US and China in terms of soybeans. At the moment, really, the actual confirmed, in terms of arrivals into China, it's very low. There are more ships heading into the US Gulf and are ready to load more in the way of soybeans. But as has been mentioned, this has been sort of going, we're talking about US government level. I've talked about a typical level of around 25 million tons a year. The aim for this year is relatively modest. It's 12 million tons for this year, rising to 25 next year, and then moving forward. And this kind of came out of a high-level presidential meeting we had between the US and China back in Korea. So at the moment, we're not really looking at the moment, I would say we're looking a bit short, even of the 12 million tons. Right. This is particularly significant because, of course, farmers need to be able to plan ahead, and they need some security in terms of buying fertilizers, fungicides, herbicides. They need to know what to expect next year as well.
All right. And another quick question. I mean, it's interesting when I looked at the charts you put at the beginning between steel and iron ore into China. I mean, you do have, kind of a flattish to a soft decline in terms of steel production in China. And yet, iron ore imports this year are going to be, hitting a new record, I believe. We will see what December looks like, but it seems that's going to be a new record high for China. How do you put these 2 things together? I mean, from one hand, you have, lower steel production, you need iron ore is hitting record highs. There is the discrepancy. Would you agree on that? Or what do you think about
Absolutely. That? On the face of it, very good question. On the face of it, there is a discrepancy between the 2. How on earth can iron ore imports not just rise, but rise significantly? Well, there's kind of various different parts to the story. If you're comparing crude steel production, yes, in the Q3, you can see there's a 3% fall year on year, just on the Q3 in China for crude steel production. If you look at blast furnace iron production, which is also measured by the World Steel Association, that is a measure really of what's being produced in blast furnaces. So what would be actually consuming iron ore and coking coal, as opposed to, say, scrap, which is about 9-10% of the market. In terms of the Q3 on Q3, the levels have been fairly flat. Mm-hmm. So that's one thing to mention, is that we also have to remember how much steel is being produced by the scrap route, as opposed to the majority in China, which is iron ore and coking coal. So in blast furnace iron production, it has been running fairly flat. But as you mentioned, that doesn't explain the iron ore import growth. For us, this leads us to a process of elimination, that some of the higher cost Chinese iron ore production has been squeezed out of the market more recently. And that would then be part of the equation, a very significant part of the equation. It's really by a process of elimination. You could also argue as well that the grade of ore coming in, there has been some lowering of the grade of ore coming into China as well from the international market, and that may also be part of it. The crucial thing, I think, and one for everyone to be aware of, is are we running up inventory levels? Are we running stockpiles higher? The ports, they have been moving higher in the last few weeks, and we would continue to monitor indicators such as that.
Yeah, that's what we've been hearing as well. All right, thank you very much again, Derek, for your time and insights. See you hopefully soon. And we'll be right back with our first panel of the day on dry bulk shipping in 15 short seconds. Welcome back. Our first panel of the day also contains some of today's top analysts in the dry bulk space, that similar to Derek also receive and process first-hand information, and thus can speak about their views and outlook for dry bulk shipping as they see it from their respective positions. So today for our dry bulk panel, we're very excited to be joined by Laura Gomez, Senior Research Analyst for Ifchor Galbraiths, who is joining us from Geneva.
Hello.
Alatari, Senior Shipping Analyst for SSY, joining us today from London. Wilson Wirawan, Head of Dry Bulk Shipping at PRS, who is joining us today from Singapore.
Thank you very much.
And Kristoffer Barth, Skeie, Equity Research Analyst at Arctic Securities, joining us today from Oslo. Welcome to all. So let's jump straight into our discussion, and my first question will be for Alexandra. So 2025 has been one of the strongest regular years on record for dry bulk. And when I say regular, it was one of the years that we haven't seen any extraordinary events that have greatly affected dry bulk shipping similar to prior years. So this time last year, there was some optimism, but I don't believe a lot of people would have predicted such a strong performance, something that was evident at the time by the freight futures curve. Interestingly, for 2025, dry bulk demand for major commodities might end up being actually down, flattish to down around 1%. Supply is running around 3% more or less. So, no matter how you cut or paste it, I think it is easy to understand that such numbers should not have been led to a rather, strong market. Now, if you were, Alexandra, for a minute to put on your detective hat, trying to find clues on what's going on, which is a good thing, but why do you think, what's your best guess on the reasons of such a strong performance over the past year?
Well, looking back, John, you're right. 2025 ended up slightly above most of our base case forecasts at this time last year. What truly stands out for 2025 is how politically charged the year was. And that might be the daily grind for tankers, for gas carriers, but the dry bulk market isn't as used to it. So what we saw was continuing Red Sea diversions, which were quite long haul, and that quietly added 1 to 2 percentage points to dry bulk demand, especially for the large bulk carriers. We had political interference in Guinea that disrupted bauxite mining. We had the US-China trade war that effectively halted bilateral grain flows. And even at times, coal demand in China and India swung with political priorities. At times, they linked to imports. At times, they carteled imports to the benefit of domestic coal production. But trade proved remarkably resilient, not at first because the year was truly that cliche, a year of two halves. So we started off soft with a sharp decline in coal and grains because China was well stocked on both, because Atlantic coal availability declined. Europe faced very poor grain harvests. The Black Sea struggled with logistical bottlenecks. But fundamentals flipped at the second half of the year. So Russia lifted its grain export quota, and the grain season in South America extended unseasonally deep into Q3. Vale also delivered very strong iron ore exports in Q3. And the smaller segments enjoyed support from very strong Chinese steel exports and other minor bulk shipments. At the same time, fleet growth was quite manageable, especially for Cape sizes, the largest bulk carrier segment. It was just at 1.5%. For the rest of the segments, fleet growth was higher because of increased new vessel deliveries, but deliveries weren't high enough to depress rates. They were just high enough to keep them contained in a narrow trading range. So that was 2025. It was a year of political volatility that didn't hit trade as much as we might have initially feared, and a year that was perhaps bumpy at times, but ultimately delivered.
Yeah, that makes a lot of sense. I mean, obviously, politics have, come into the forefront of shipping, something we haven't been used to it for many, many years. But we're sitting now less than a month away from 2026, and it could be a year that will have a kind of a return to fundamentals type of exercise. So from a pure balance perspective, supply and demand, and given where rates are today, which is quite strong, how do you see the next year playing? And I will go to Kristoffer to ask about that. How do you think all these major factors that will affect the progression of rates, both in the near term, but also as you look into next year? Do you think it is indeed a return to fundamental story, Kristoffer?
Yeah, it's a good question. So we're coming off sort of, when we're looking at rates at least, from quite the average year. So just looking at Capesize rate performance, it's more or less in line with the 5-year average. So by looking at the figures, the number has been quite ordinary. When looking into 26, I think the supply side still looks supportive in terms of the supply-demand balance. Order book to fleet ratio is still relatively comfortable at 9.7%, and fleet growth will likely slow into 26 from 3.3% to maybe close to 2.5% next year, depending on sort of where you see scrapping playing out. So this is more sort of the outlook is much more sort of dependent on how the demand story will play out. So we can try to make it quite simple and break it into a couple of supporting events and a couple of obstacles ahead. On the supporting side, there's new capacity coming on stream, contingent on adequate demand, which will likely lift ton-mile demand. So on iron ore, for example, and as also mentioned in the presentation earlier, there are several new mines that are coming on stream in 26, but there's one project that is really standing out, and that's Simandou in Guinea. So the 120 million ton project prepared its first loading last month, and the first vessel winning use is set to arrive in China in the middle of January. So if we just assume sort of full ramp up of this project over coming 3 years, then sort of you're absorbing 85% of all the Capesizes on order. So it's also quite high expectations into this project, and we see a lot of ordering on the back of it. China, biggest owner here, also expected to take most of the volumes, which in turn we could see some cannibalization of Australian volumes. But the trip from Guinea to China is 3 times the duration or sort of ton-mile intense as Australia to China. So I'm guessing it will be quite supportive, but I think ramp up may be slower than what some expect. Rio Tinto hosting their CMD today, and they are expecting 5 to 10 million tons of exports next year from 50% of the project. So obviously not sort of very fast ramp up. And there's also an obstacle related to the project besides potential delays, and that's the cannibalization of Brazilian volumes. So in a scenario where ton-mile effect would, or sort of, should that play out, the ton-mile effect will be close to neutral, as the sort of distance and voyage length is quite similar as the Guinean exports. And we saw this week that Vale also on their CMD took down their 26 guidance by 10 million tons on the midpoint guiding. And that's also the equivalent of what we are going to expect from Simandou next year. So they are also a bit worried on that, or in terms of new volumes, and are also quite bearish on sort of long-term demand of iron ore. So the company, the miner, estimates a demand reduction of 160 million tons from China within 2030, and they are expecting to see global seaborne volumes decline by 1.1% per annum over the coming 5 years. And if this scenario materializes, it's not going to be good for iron ore volumes. That is representing 72% of ton-mile demand on the largest vessels in dry bulk. However, it's 5 years down the road, and a lot can happen.
Yeah.
And the other important point I would like to touch upon is bauxite, which has displayed immense growth over the recent years, growing by a CAGR of 7.1% since 2019. And bauxite is a feedstock metal into aluminum production, and thus supporting sort of several industries in China, among them EV, which has been really fast growing recent years. And during 25, we saw the first instance of bauxite volumes exceeding coal volumes on Capesize fleet. China is far the largest importer, 75% of global iron ore volumes and 30% of coal volumes, and more than 85% of bauxite volumes. So the state of Chinese economy is sort of remains the key question mark into 26 in our view. So how that will play out is difficult to have a good answer on, but the supply side continues to look attractive at least.
All right. Yeah, I mean, I think like that's kind of like so far my understanding of our previous panelists, but I want to turn to Laura a little bit, and I don't want to focus so much again on market balance, which I think like most people will understand. We have some supply growth, demand kind of uncertain, but one thing that this year has played out quite well has been seasonality. And we had the soft first of the year, and then the second half of this year has been particularly strong. So when you talk about averages, this could be skewed to the upside. So based on what we know about all this new iron ore from West Africa and the bauxite, and historically some have been weak, but this year has been strong. How do you think rates will progress next year? Do you think that there is a change in these seasonality patterns? Should we think about the first quarter as not being particularly weak as it used to be? What do you think, Laura, for the next 12 months?
Well, definitely, yeah, some of the things have been already said by Derek and also Kristoffer, and we're pretty much aligned in terms of the S&D. Again, we are seeing more supply coming into the market, mostly for intermediate segments, whereas we are very positive for the Capesize. Now, turning back into your question, if seasonality is going to play a big role, I think, yeah, in this case, we're going to see change of patterns. So I think also seasonality is going to change next year. It's going to be interesting to monitor Simandou mainly, because it will not only bring an increase of ton miles for the Capesize, but also increased congestion in the area, which is at 5-year high, by the way, in Guinea. We are also going to see more short squeezes in the Atlantic. So this is going to be a pattern that is going to change probably as well next year. And also with this high influx of iron ore supply, we believe that iron ore prices are going to decrease, which is probably going to shut down some Chinese domestic mines. And this is going to encourage imports from China, which are, by the way, not at very low levels. What else is important to monitor for next year? We believe that the coal story in Indonesia is going to be very important to be monitored, especially if at the end the country officializes their export duty on coal, because this could encourage China to mainly support more and more domestic production and reduce their imports. And also as well, it's going to be important to monitor if at the end of the year, China is going to buy what they promised to buy from the USA, those 12 million tons. For now, I have seen the question that you have made to Derek, and for now I've seen maybe 2 to 3 million tons being bought. So I think it's going to be important for intermediate segments if those volumes are leaving the USG and mainly going via the Cape of Good Hope instead of the Panama Canal. Of course, next year, I think it's worth to mention, I believe, is going to be the congestion, even though it's very difficult to forecast, but it's right now at 5-year low, so there's a meaningful upside. And also, we believe that Red Sea transit resumption is going to be a negative factor, which will impact freight rates.
All right. I guess, again, a lot of focus on China. And I want to talk with Wilson a little bit about that. Even geographically, he sits closer to China in Singapore. So I'm going to, again, ask about this disconnect between steel production in China and iron ore imports in China, which I think is something that is difficult to see persisting for many, many years going forward. So what do you think about that, Wilson, between steel production and iron ore imports? Is it something that can persist in 2026? And second, on the Simandou, just give us your thought as well, please.
Okay, thank you. So just to give a bit of background context for the audience. So with the recent release of the October data, China iron ore imports have finally returned to a positive year-on-year growth of about 0.7%. But this development does not mask the harsh fact that the Chinese steel industry is still facing several structural headwinds. So, for instance, on a volume basis, China had already reached its peak steel production back in 2020. And actually, if you look at the last couple of years, the steel market has essentially been a cycle of rising hopes followed by recurring disappointments. And it's quite telling that neither the traditional peak seasons for steel demand, namely from March to April and from September to October, had really delivered the strong rebound that many had hoped for. And to be honest, these hopes are not misplaced or misguided, just from the standpoint that it's only last September 2024, that Beijing released a stimulus package which specifically took aim at addressing China's property woes. But fast forward to date, it is quite apparent that this measure had limited impact, and also demonstrated by the latest news that one of China's largest real estate developer is now seeking a 1-year delay to pay one of its bonds that is due on 15 December. Meanwhile, China is also rolling out its anti-involution campaign, which aims to reduce overcapacity across multiple sectors. That, of course, includes the steel market. So this reflects the internal shift from quantity to quality. So with this big picture at the background, we expect that in the next couple of years, China's steel demand and steel production will be ready to enter into a slow and steady decline, somewhat of a new phase, and it's likely to become the new normal. That said, as my fellow panelists also mentioned, if there's continual high levels of steel export, that might keep the Chinese steel market generally balanced. And also just to bring back the attention to dry bulk, currently the dry bulk market is in what we call a sweet spot with regards to seaborne iron ore and steel shipments. So on the iron ore side, while growth over the last couple of years have visibly slowed down, this is, as obviously mentioned by my fellow panelists, that is compensated with long-haul shipments coming from Brazil and Guinea due to, number one, China need to prioritize resource security in the face of heightened uncertainty and geopolitical tension, and second, obtaining higher grades, iron ore, 65% and more, for green steel production. So alternatives from Australian supply are much needed and much appreciated. And on the other hand, to offset weakness in the domestic steel demand, as mentioned earlier on, China has been quite aggressive exporting steel to the rest of the world and has been somewhat successful given the supposed tariff that's been thrown towards it. And this has definitely helped to boost the Far East demand for geared barges, reducing ballast leg and improving fleet utilization, especially for the Handysize and Supramax unit. And we believe that this sweet spot might have legs going into 2026, but how long it can last, it's a question mark in itself. After all, the jury is still out there on the eventual impact on this new world trade order that President Trump has kindly trusted us into. Thank you.
All right. Yeah, I mean, I think like the Simandou is basically, from what I understand so far, the biggest story here. And I'm going to go back to Alexandra and Laura. The question here, first to Alexandra, is like, as you model next year and the year after, I guess, where, Vale said that actually seaborne iron ore will be flat to down for the next 5 years, actually more down. So if Simandou is coming with a lot of iron ore, somewhere else we have to lose these exports. And how do you see the market balance here? I mean, we have, the numbers should be flat. We have about 25, 30, 40, I don't know how much from Simandou. Where are we losing that? And what does it mean for iron ore price? So first to Alexandra, then to Laura.
Well, you're right that we might start to see some reshaping of global iron ore trades, but perhaps not in its early days. If we look at production forecasts for Simandou for next year, even the most optimistic one doesn't look transformational, simply because ramp-ups of this scale take time. Yeah. Still, it's new supply hitting the export market, and given the ownership structure of the mine, it will probably head to China, so that's a positive for Capesizes. But we expect in the early days, China to be largely able to absorb this incremental supply without meaningfully disrupting its imports from any other origin. Further out, the story might be quite different because China cannot possibly absorb all of that incremental iron ore without changing its import patterns, so something will have to give. The most exposed are probably the highest cost producers, India and Canada in particular, because more supply typically brings downward pressure on pricing, and that would challenge their economics. Australian miners might also feel a squeeze, not because they're not price competitive, but because Australia is a mature system and it has been facing some slight declines in its highest grade reserves recently, which is precisely the quality bracket that Simandou brings online. And as you mentioned, John, Brazilian miners have also signaled their intent to somewhat diversify their customer base. Mm-hmm. So none of these developments are seismic shifts on their own, but down the line, when Simandou delivers substantially more production, they could recalibrate the global iron ore trade. Perhaps it won't be a one-for-one displacement story if iron ore demand from China proves quite resilient, despite all the headwinds in its steel industry. But simply focusing on 2026, we think Simandou will be an additive, not a substitutive in the market, and a welcome boost to Capesize demand.
All right, Laura, your thoughts, please.
We mainly think that Simandou is going to substitute China's domestic production, and mainly because China's own iron ore mines are at the most one of the most expensive mines in the world. We believe that China doesn't have a problem of steel overcapacity, rather a problem of margins. So the aim wouldn't be to shut down those mills, but rather lower import costs by importing cheaper iron ore, which is what Simandou is going to bring. So this is why we believe China is going to continue to import and to decrease their domestic production, which, by the way, is already down 3% year on year in 2025. But of course, I think in here we need to keep things in context, right? Simandou, yes, when running at full capacity, is going to bring 120 million tons into the market. But this is, first of all, 10 to 15% of what Australia is producing and nearly a third of Brazilian's production, and also nearly what could China import in just a month. So yeah, Simandou stones are certainly significant, but when put in a context, they don't seem that big. Another question would be, who is going to get priority in here? And of course, knowing that Chinese companies are involved in Simandou, such as Winning, Chinalco, and Bahu, it's very likely that Guinea and iron ore is going to get the priority over other top producers in the world.
All right, we're running a little bit behind, so I'm going to go very quickly to Kristoffer on a totally different subject here, and for a couple of minutes talk about investor appetite in the shipping space. Obviously, headlines about geopolitical risk, politics, tariffs, all these things are almost a daily occurrence here. Do you think that there is more appetite from investors for shipping versus, let's say, the last couple of years? Have you seen a pickup in activity? Just a minute or so, please.
Yes, in general, there is really good appetite for commodity shipping still. I mean, dry bulk, but also tankers benefit from sort of having a very appealing supply balance and sort of fantastic age profile, given sort of many of the vessels that were ordered in a 08 boom are sort of soon to be 20 years or older. So we're seeing a lot of replenishment potential here, and I think that's keeping sort of many investors quite involved here in this space, because they see that over the coming years it's going to be quite difficult to sort of destroy the supply side. Obviously, in terms of equities, we have lost Golden Ocean, but then gained CMDT, which is sort of a big dry bulk exposure, but also other companies have sort of exited the public space. So in general, there's good appetite, but it's a shame that we have sort of the public space has become a bit smaller.
Yeah. All right, so we're almost done here, but obviously we cannot go and close this panel without some predictions about 2026. We've done that every year, and I will focus on the large Capesize ships here that are the most volatile. And as we speak today, the futures curve are predicting Capesize spot rates to average around 24,000 next year, which is quite a bit higher where it was this time last year, where the market was predicting 18,000. Now, obviously, we're going to settle maybe above 21,000, so 1821. We did better than what the futures was projecting, but right now the future is projecting 24,000 per day. So let me go around and ask each one of you, do you think there is upside or downside on this number as you look at your forecast for next year? I will go first to Alexandra.
I wouldn't be surprised if we average higher next year, so in the mid to high 20,000s, because as was discussed earlier on, the Capesize market is facing decent long-haul trade growth, and that means very low fleet expansion. And if we manage to see some support from the mid segments, then Capes could finally trade closer to their full potential. And those are extremely profitable levels we've only seen at times of major tightness, geopolitical or demand-driven. Of course, there are moving parts, as Derek outlined earlier on, but even in that case, we believe the market for Capesizes could remain tight and could average in the low 20,000s, still a very profitable range. So looking at our base case for next year, the question isn't whether the Capesize market will be strong, it's how far above its weight it can punch and how geopolitics will steer the outcome.
All right, I like that. Laura, what do you think, 24,000 for next year?
We expect 2026 to be a strong year for Capesize vessels. Our base case is around 25K, but we do not rule out the possibility to even reach 30K levels that we saw in 2023, despite being 2023 a very weak year for steel. So yeah, that's our point of view.
All right, Wilson, what do you think? 24,000 next year?
I think 24,000 is fair representation or fair valuation given the prevailing circumstances. But I would like to add that if we were to see Capesize rate hitting 25K and above, I think we need to see additional drivers. First, we need to see a sharp rebound in Capesize coal shipment. Secondly, we also need to see more Capesize demand outside of China, namely Japan, South Korea, and India. And lastly, maybe unexpected or prolonged congestion of port congestion from Guinea, as we've seen in early Q1 of this year.
Great. And Kristoffer, what do you think?
We've had 29,000 in estimate on conventional Capesize for next year for quite some time now, and it's nice to see that the paper market is finally starting to agree with us. There are two factors that's driving this. It's sort of relatively decent supply-demand balance, and also the fact that at current new build prices, you need rates to improve material in order to justify sort of fleet replenishment. So we believe it's still upside here.
All right, excellent. So very optimistic forecast for next year. Thank you all very much, and especially Wilson for staying up late for our panel today. And with that, we'll be back in 15 seconds with our next segment on tankers. Welcome back. Our next hour focuses on tankers. Over the past year, tankers have experienced a major revive with the core VLCC segment, which is the super tankers, reaching multi-year highs and currently earning more than $100,000 per day. Historically, oil production increases have positively affected tanker rates, and given the fact that OPEC has added more than 2 million barrels per day into the market over the last year, tanker owners have seen their fortunes grow. With a limited order book and little sign of a cut in recent production additions, it seems the future looks bright for tankers, or isn't it? So now, with no further delay, I would like to introduce our next segment that focuses on the current state of the crude tanker market, and primarily the very large crude carriers, or VLCCs, that drive tanker demand and the outlook for next year. We're very excited to have with us again, for the second year in a row, our next presenter, that has been a key voice in the shipping market with her timely and very thoughtful presentations. As the global head of research for Tankers International, Mette Frederiksen is providing some of the best content and outlook for the crude tanker markets. Tankers International is the largest pool of super tankers in the world. So from where Mette sits, she can really see and understand a lot of the drivers of today's crude tankers, as well as oil flows. So now join us now live from London. I want to welcome Mette, who will provide us with her views and outlook for the tanker market. Good afternoon, Mette from New York. Please go ahead with your presentation.
Hello, everyone, and thank you, John, for inviting me to share my thoughts on the tanker markets with everyone today. As you mentioned, Tankers International, we run the largest pool of VLCCs in the market, and this year we can actually celebrate our 25th anniversary. And during the past 25 years, not only have we run a VLCC pool, but we've also collected a lot of data for the VLCC segment, both in terms of the fleet and in terms of trading. And I'll try and lean into that data today and focus my presentation on the VLCC market. Of course, many of the topics I'll cover will be relevant across all of the tanker segments. And I'm sure my colleagues on the panel afterwards will be able to add a little bit more detail on some of the smaller tanker segments. If I could have the next slide, please. So probably won't be a surprise to anyone who has been following the tanker freight markets that 2025 has seen things really take off, especially going into the third and the fourth quarters. We've seen extremely positive numbers in the VLCC market, with TCE returns pushing beyond $100,000 per day and remaining at that level. On the chart on the left, we can see how 2025 freight levels actually tracked the 2024 rates pretty closely until just about August time, when 2025 rates began to climb. And what I want to do today is to take a look at what has happened to explain this surge, and perhaps more importantly, try and look ahead to whether this is a sustainable increase or whether we are likely to see the market drop back down sometime soon. So if we turn to the middle chart, we can see a big increase in crude and condensate on the water. And on this chart, I have shown VLCC specifically. And we can see that this rise closely mirrors the freight market. So more oil on the water, keeping more vessels occupied for a longer period of time. And we can see this reflected on the right-hand chart as well, where we see global ton miles for the VLCC segment rising in tandem with the oil on the water. I like to use this ton mile chart as a measure of vessel demand. And with vessel demand rising, the VLCC supply-demand balance has shifted to a point where the freight market has reacted in a positive way. And this is why we are seeing the freight market increasing. So now let's take a look at some of the key drivers of the market in 2025. So if I could have the next slide, please. The first driver I want to look at is global oil supply. For us to see more oil on the water, we need supply to rise, and it certainly has this year. If we look back to 2024, we saw very limited supply growth of less than 1 million barrels per day. And all of this came almost exclusively from non-OPEC producers. But in 2025, supply is set to grow by 2.8 million barrels per day. And this year, crucially, we are seeing growth both from OPEC and from non-OPEC producers. We, of course, saw OPEC beginning to reverse their voluntary of 2.2 million barrels per day, fully restored by September. And they've been adding further increments since then. And once we started seeing those barrels reaching the export markets, was when we started seeing the effect with rising cargo counts across the VLCC segment. And at the same time, non-OPEC production has stayed relatively strong. As shown in the middle chart here, year-on-year global supply growth reached around 6 million barrels per day in September. We don't necessarily expect these extreme levels of growth to persist, partly because OPEC have already signaled that they're going to slow down the pace of adding more supply. And partly because the year-on-year baseline will increase as 2025 becomes the new reference point. But even so, we are still on track to see more oil also going into 2026. And on the right-hand chart, I show expected non-OPEC supply growth in 2026. And all of these barrels add up to about 1.2 million barrels per day. And what matters for the VLCC market here is that much of this growth is still coming from west of Suez locations. We have South America remaining strong, with Brazil, Guyana, and now also Argentina adding more barrels. And we also continue to see the US and Canada here. So all of this adds up to a very positive outlook on the supply side. If I could have the next slide, please. So even with more oil supply, the tanker markets only really benefit if this supply is matched with a similar level of demand growth. And according to the EIA, global demand growth in 2025 is just above 1 million barrels per day. And 2026 is expected to look very similar. Even if we look at it at a regional level, as I've shown in the chart on the left, the picture doesn't shift much between 2025 and 2026, with the exception of India, which shows a much larger increase in 2026, while the Middle East and Africa are both coming in a little bit lower. On the left chart, we can also see how China is now back at the top of the growth charts, although now at more modest levels than we have perhaps been used to seeing in previous years. And what's most interesting for the V market, of course, is this ongoing geographical mismatch we're seeing between where the supply is growing in the West and demand is growing in the East. Even if this mismatch is not as extreme as we have seen before, there is still roughly around 500,000 barrels to about 600,000 barrels of additional demand in the East that does need supplying from the West. And if we assume about 500,000 barrels more moving west to east on VLCCs, that volume alone is enough to keep more than 20 VLCCs employed full time. Next slide, please. So if we take a closer look at China, which remains one of the key demand drivers for the VLCC market, when I spoke to you here a year ago, I highlighted that China was one of the main reasons why the VLCC market at the time wasn't as strong as we had expected. And this was due to demand growth being slower than forecast. And also at the time, China was taking more crude from sanctioned sources, and this was carried on sanctioned ships. So we didn't see the benefits in the mainstream market. This year, however, China has increased the total amount of crude coming into the country. So on the left chart, you can see this steady rise through 2025, reaching around 12 million barrels per day in October. And this compares to an average of under 10 million barrels per day in 2024. So we are roughly 2 million barrels up at the moment. And what matters for the VLCC market here is, firstly, that much of this extra oil is now coming from non-sanctioned sources. And secondly, it's traveling from long-haul regions like South America and West Africa. And the middle chart here shows how mainstream VLCC ton miles into China, so VLCC demand into China, has increased strongly on the back of these longer routes. And the third chart shows in more detail where China's VLCC demand has changed between 2024 and 2025. South America alone has employed almost 15 additional VLCCs this year. West Africa is up by about 3. And at the other end of the scale, we have US volumes, which are down by about 5 VLCC equivalent. And this is due to the ongoing trade tension that we have seen between the two countries. We've also seen a small increase in sanctioned barrels going into China. And this, of course, is carried on the shadow fleet. The Russian crude comes mostly on smaller tankers, but Iranian and Venezuelan flows often arrive on VLCCs. So this also means we still see more older ships continue to migrate into the dark fleet, leaving fewer mainstream VLCCs available. Looking ahead to 2026, underlying Chinese demand is expected to be similar to 2025, as we saw on the previous chart. The key question is how much of the recent flows and ton miles into China is driven by real consumption versus what is driven by stockpiling. And I think it's likely a mix of both. China has been adding to its SPR through the year, and the current mandate is running through till March 2026. Many do expect a new mandate to follow, and we are hearing reports of new storage capacity already being built. And the current crude price environment is supportive of China continuing to expand its inventories. And if we do see that continue, China will still need VLCC tonnage. And as you saw earlier, much of the supply growth feeding this demand will come from the Atlantic Basin, which will continue to push the ton mile story higher. Next slide, please. Of course, China isn't the only factor shaping the freight market at the moment. We have seen many geopolitical events through the year. Some of these have caused short-lived volatility, while others have created deeper, more long-lasting impacts. One of the major changes has been the growing use of sanctions of individual tankers, both from the US and globally. And this has cut the number of compliant ships available for mainstream business, effectively shortening the tonnage list without physically removing these vessels from the fleet. And I think we need to try and distinguish between the roughly 100 or so officially sanctioned VLCCs and the much larger group of ships that have carried sanctioned crude at one point or another. Because once these vessels get involved in the dark fleet business, it is unlikely to return to mainstream work. So out of today's VLCC fleet of around, I think it's 886 ships, 200 of these have carried sanctioned oil at some point over the past 2 to 3 years. So that's 23% of the fleet. And on the left-hand chart here, I show this distinction by age group. And you can see that it's almost all vessels 20 years or older are trading within the shadow fleet, meaning they're no longer a real competitor in the commercial space. And this is also why I like to look at what I call effective fleet capacity and not just the headline fleet count, but I'll come back to that a little bit later on. Another sanctions-driven shift came from the US imposing extra tariffs on India for their continued buying of Russian crude oil. And on the middle chart here, we can see that India temporarily moved away from Russian barrels on the darker blue line at the top and replaced them with Atlantic Basin oil. And we saw the effect in the V market with demand increasing in the V segment on the back of this. And that's the lighter blue line at the bottom there. Russian flows into India have since rebounded, but we could see this reverse again, given that the official deadline for dealing with sanctioned entities passed at the end of November. So the market does expect a new drop in Russian flows going into December and into the new year. And any replacement flows, if they were from the Atlantic Basin, they would again support the VLCC market. The last geopolitical factor I want to speak to today is the US-China port fee disputes, which caused disruption more so than actual changes to trade flows. It started with the US introducing new port fees on Chinese-built, Chinese-owned, or Chinese-operated vessels. And this instantly removed about 28% of the VLCC fleet to participate in US trade. But because the US only accounts for around 10% of VLCC fixtures, the main effect was added inefficiency, and the market pretty soon adapted to this. China's retaliation when it came had a slightly bigger impact. China introduced its own port fees on US-linked vessels with a very short notice period. But only about 6% of the VLCC fleet has US ties. But because 37% of global VLCC fixtures involve China, the effect in terms of disruption was much larger. These extra port fees from both sides have now been paused for 12 months, and both sides can now sort of trade more freely again. Next slide, please. So I just want to return to the earlier chart showing crude and condensate on the water, and again, specifically on the VLCCs. We can clearly see here the red line representing 2025 has pushed far above historical range. And as I mentioned earlier, this rise mirrors the jump in VLCC demand, which in turn has helped fuel the stronger freight market. And there are several reasons why crude on water can rise, such as more vessels being pushed into floating storage, delays in discharge operations, longer voyage distances, and even slower speeds. All of these can keep ships employed for longer. So the first thing I looked at was floating storage. And we have seen a small increase in floating storage through the year, but not really enough for it to be a main driver. And on the middle chart, the blue bars at the bottom show this small increase in floating storage. In the first quarter, it was around 5% of the crude on the water was floating storage. And by the fourth quarter, the share had risen to 7%. So the majority of the increase must come from oil in transit and not oil sitting still. So on the same chart, I try to show which regions have contributed the most to this rise in crude in transit. So in other words, which countries have seen the biggest jump in barrels moving on VLCCs. And here we can see both Iran and Venezuela, meaning more sanctioned oil in transit. So these barrels are heading mainly to Asia, but they move very inefficiently. They face delays, and the ships often end up waiting around to discharge. So this keeps them tied up for longer. The other big contributors are countries that have simply pushed more barrels to the market. So we see Brazil, we see Saudi Arabia, and the UAE showing good increases here. The Brazilian volumes are up, both due to more oil coming out, but also due to the longer distances that this oil has traveled. Saudi Arabia and the UAE, they're both up after the rollback of the OPEC voluntary production cuts, which has allowed them to send more of their crude into the export markets. And one more point I wanted to highlight here is vessel speed. When I track average VLCC speeds month by month, we see a small drop in laden speed from around 13.7 knots in the first quarter to around 13.3 knots today. And this may seem like a small drop, but across a global tanker fleet of 886 vessels, this reduction equates to roughly 8,600 sailing miles lost every day. And what's driving this is a combination of full refineries, storage tanks, and also buyers becoming far more conservative around sanctioned barrels. So these barrels are getting harder to place, and as they get redirected or delayed, they cause congestion at key ports. And because of this, many charterers are now, or some charterers are instructing vessels to slow down, even if slowing down means added demurrage costs, as it helps them time their arrival better and avoid making congestion worse. So the increase in crude on the water is driven by a mix of all of these factors. A small portion is driven by floating storage, but the majority has come from rising crude in transit. Around half of the crude in transit, change in crude in transit was sanctioned barrels that are trading inefficiently, and the remaining half came from these additional mainstream barrels being moved on VLCCs. The sanctioned barrel component will always be more volatile, but the lift in mainstream volumes and the structural shift towards more long-haul routes is a more sustainable increase, and it's likely to remain in place. So we should expect this crude in transit measure to remain higher levels than normal, but not necessarily at the peak levels we see today. Next slide, please. So far, I've talked a lot about vessel demand. Demand is the more flexible part of the supply-demand equation, which can change pretty quickly, but it's equally important to also look at the supply side. After a period of very few deliveries and a fairly static fleet, we are now heading into a period with a stronger new building schedule. And if you look at this new building schedule in isolation, it might seem worrying from a freight market perspective, because normally more ships mean a looser tonnage balance and softer rates. And on the first chart here on the left, we can see that in the past 2 years, only 6 VLCCs delivered into the fleet, far below the 10-year average, which is around 36 deliveries per year. So the obvious question here is, should I be concerned about the 40 or so new vessels that are set to join the fleet next year? And my argument would be no. And the reason here, or the reason lies with the age profile of the existing fleet. Close to 20% of today's VLCCs are now 20 years or older. And vessels in this age bracket just don't trade as efficiently as their modern counterparts. Yes, they still physically exist in the fleet, and yes, they do occasionally move a cargo, but the cargoes that keep them employed tend to be very sporadic, and they're often sanctioned. So if we look at the middle chart, which shows the average annual employment days by age group, this pattern becomes very clear. Up to about 15 years of age, a VLCC's employment doesn't really change much. After that, utilization begins to drop. The darker blue line here shows utilization across the entire VLCC fleet, so including sanctioned business, while the lighter blue line excludes the sanctioned trades. And here you can see that from the age of around 20, these vessels are essentially no longer doing any mainstream business. And the gap here between the two lines represents the dark fleet activity. And even here, you can see utilization falls to about 50% once a vessel reaches 20 years. And it's that drop in utilization that really matters on the fleet side. Because even if an older vessel is not physically removed, it no longer works anywhere near as much as a fully employable modern VLCC. And each year from the age of 15, vessels lose around 10% of their utilization. And when you have a large aging fleet, those small losses all add up to a significant combined loss of effective capacity. And that's what I've tried to capture on the chart on the right, where the yellow bars show the global combined change in utilization. And when you compare this to the amount of capacity coming in via the new buildings, you can see that net, the picture is far less concerning than the new buildings numbers alone would suggest. So we may of course see more orders appear in the later years, but as things stand at the moment, we are still on track for a manageable fleet growth, comfortably below 3% in the medium term. And this is a level that the market should be able to absorb. Next slide, please. So just to summarize, firstly, VLCC demand this year has been very strong, largely because of long-haul flows and a jump in crude in transit. China has returned as a supportive import market, with more mainstream barrels coming in and more of them traveling long distances. But we also have to recognize that part of this strength may be tied to stockpiling, and stockpiling policy can change more quickly than underlying consumption. Geopolitics and sanctions have played a major role in reducing the effective fleet size and driving operational inefficiencies. Crude on the water remains elevated, and while it may not stay at the current peak levels, we are likely to see it stay higher than historical norms. On the supply side, the aging fleet continues to be a key factor. Older vessels are less efficient, and this drop in utilization is a genuine offset to new building deliveries. So overall, the market is supported by strong fundamentals from longer ton miles, Atlantic basin supply, and an aging fleet, but it's also balanced by a number of moving parts, such as OPEC production, Chinese buying patterns, and geopolitical shifts. So heading into 2026, all of these variables will be important to watch, but the underlying fundamentals should still keep the freight market in good shape. Thank you.
Thank you, Mende. I know we have like just less than a minute left, and I want to get an answer out of you on that. How worried are you that the whole oil in the water story unwinds and hits rates into 2026?
Well, I think, as I said, that there are several elements to this oil on the water, and it's the oil in transit. I think is the important element, and the bit coming from South America, from OPEC. All of those barrels are there, and they're traveling longer distances, and I don't see them disappearing anytime soon. I don't think we're going to remain at those super high levels that we are seeing at the moment, but we're not going to go back down to the bottom of that chart.
All right. Thank you again, Mende, for your time and insights. That was very, very helpful. And we'll be right back with our second panel of the day on tankers in 15 short seconds. Welcome back. Our last segment of the day also focuses on tankers. As we heard from Mette's presentation, the uncertainty around geopolitics continues to make the fundamental analysis complicated, especially for the oil-dependent tanker sector. However, there is more to consider than just that, and hopefully our next panel will shed some light on all these factors. For that, we'll go to Athens and my colleague Thanos Sofios, who will moderate our next panel on tankers. Thanos, good afternoon from New York, and the floor is yours. Please go ahead.
Thank you, John, and thank you, Mette, for the excellent overview. The VLCC market is ending the year with remarkable strength. After a quiet first half, we are now seeing a broad rally driven by longer trade routes, geopolitical reshuffling, and a historically tight fleet. China's pull remains significant, part real demand, part strategic, while sanctions continue to reshape ton miles and tighten effective supply. The key question now is how much of this strength can carry into 2026 and what could disrupt or accelerate the momentum. And that's exactly what we will explore with our guests today. So for our tankers panel, we are very excited to be joined by Eirini Diamantara, research analyst at Xclusiv Shipbrokers, who is joining us from Athens, Mary Melton, senior tanker analyst at Braemar, joining us from London, and Ioannis Papadimitriou, lead freight analyst at Vortexa, joining us today also from London. Welcome to all. So let's get started. We will have 3 rounds of questions. The first question has to do with the current status of the market and the outlook for next year. I start with Ioannis. Ioannis, the crude tanker market finishes the year exceptionally strong. What's your view for 2026?
Thank you, Thanos. First of all, let me say that it is a pleasure to be here with you. So as we look ahead, I think it's fair to say that crude tanker market has been sailing through an extraordinary environment, and that's especially true for VLCCs. So we've seen this high crude supply combined with discharge delays that has stretched voyage duration, as Mette also discussed earlier on, and this is quite reflective in the mainstream VLCC segment. And by mainstream VLCC segment, I mean vessels that are not involved in the sanctioned trades. So because of these prolonged discharge times, oil and water for these crude tankers has climbed to historical highs. The active ballast VLCC fleet is actually at its lowest level since the third quarter of 2020. And at the same time, on the export side, these remain near 5-year highs. So for these barrels trying to move across the water right now, there's essentially a missing vessel that should be loading the cargo. So why I'm making this recap is because I think this is important in order to note, in order to acknowledge what actually comes next. So these delays, to answer previous John's questions, I think they will eventually unwind. And this will happen likely in the short term. And this at the same time happens while there are question marks around how strong oil demand is, which are continuing to build. So I believe that once this delayed discharge is finally clear in this questionable demand environment, 2 things will occur. So first of all, vessel capacity will free up. And then on the other hand, also inventories will start rising, which could pressure crude price further downward. So with these lower prices, exporters, especially within OPEC, may again consider cutting volumes in order to stabilize prices. So this could soften trade demand and could create more balance and possibly softer environment for VLCCs. But of course, that does not necessarily mean that we're heading back to the rate levels of 2024 or the first half of 2025. There are some structural supports for 2026, which should not be overlooked. On the one hand, we have the supply growth from the Americas that is gaining momentum. And then on the demand side, we're seeing the shift of refining capacity from the west to east, which, as Mette discussed also earlier on, will support voyage distances and the ton-mile demand. And also talking about demand, looking to the second half of 2026, there is reportedly China may expand its inventory capacity, which could give the market an additional lift. So to synopsize for 2026, we might see a pause on the current rally as these, like extraordinary factors unwind. But the underlying fundamentals of these long-haul voyages and this new VLCC production growth from the Americas will keep the market at healthier than 2024 levels.
Thanks, Ioannis. Mary, turning to you. This year's summer strength went against typical seasonality. What was driving the resilience in the markets during that period?
Thanos, and thanks for having me. What we saw this summer really had to do with different geopolitical factors, a few of them geopolitical shocks. So we had a big spike in VLCC rates in June during the 12-day war between Iran and Israel, but we didn't actually see any fixtures done at that level. But that did happen because there was a threat to close the Strait of Hormuz, which is responsible for shipping nearly 25% of all oil and about 33% of crude flows. So that spike happened in June. Then rates fell back down. But where we saw the sustained strength in the crude market also had to do with geopolitics. But this came from tariffs. The Trump administration put a lot of pressure on India for continuing to buy Russian oil. That then took the form of an additional 25% tariff in late August. So at that point, and kind of leading up to that point, we saw India buy more crude from non-Russian sources. About 30% of that was from the Atlantic. So that means West Africa, South America, and North America. And those are much longer haul voyages. And this was also on the compliant fleet that wasn't trading in Russia. So this really benefited Suezmaxes and VLCCs. So that sent freight rates higher. We had those higher ton-mile voyages, like both Ioannis and Mette have mentioned, but we did see that trend begin this summer. We also had an open arb for flows going from the west to the east, so East Asia. This drove rates up because, again, that's a long ton-mile and a very high ton-mile voyage. But we've really seen kind of a lot of those fixtures that were made in that late summer period begin to materialize in liftings and departures throughout September and October. So that was really driving the strength we saw then that was kind of counter-seasonal.
Thanks, Mary. Eirini, turning to you, looking into 2026, how do you expect the year to differ from 2025? And what are the key forces you believe will define the market? Eirini?
Sorry for that. First of all, thank you very much for your kind invitation. As we look ahead, the crude tanker market in 2026 is being defined by a combination of structural, geopolitical, and demand-driven forces. The crude tanker market finishes 2025 exceptionally strong, with earnings accelerating sharply in the second half of the year. And this rally came from several forces synchronizing. First of all, the fleet growth was minimal in 2025, especially for the VLCC, with only 6 deliveries, while at the same time, the sanction or dark fleet kept expanding. These vessels were allocating in long, inefficient trades or used as floating storage, effectively removing them from compliant supply. Sanctions on Russia and Iran pushed record volumes into floating storage, preventing a larger supply glut and keeping the market balanced despite trade disruptions. Geopolitics had further support. Suezmax and Aframax tankers still avoided the Red Sea, which continue to push ton miles higher and continue to support rates. On the demand side, China was a major driver throughout 2025. Seaborne crude imports were up by about 5% year on year, and October stood out as the most active month in at least last 4 years. This strength came from high refinery runs, restocking activity, and more buying of long haul from the Atlantic Basin, Latin America, and the US Gulf. Now, as for our review for 2026, we believe the crude tanker market is heading into a structurally tighter environment. However, geopolitical developments and potential wildcards, such as a relaxation of sanctions or a possible escalation in Venezuela, will play a decisive role in shaping the market. Although the crude fleet is set to grow by around 4% next year, the effective supply available for clean and compliant crude tankers will be notably smaller because of a continued expansion of the sanction fleet. If sanctions were to ease, the aging crude fleet, now with an average of 13 years old and many of them in poor condition, we may see an acceleration in demolition activity. Finally, the oil market appears to be entering into 2026 with a large and growing production surplus. Early year excess output could push Brent into mid-50s to around $60 per barrel, supporting floating storage and restocking. Overall, despite the nominal fleet expansion, effective supply tightening should keep the crude tanker market, particularly the larger segments, on a firm footing into 2026.
Thank you, Eirini. This concludes the first round of questions. It was very insightful. Staying on the supply side, Eirini, and I'm staying with you on this second round of questions. With the recent pickup in new building orders, do you see a risk emerging on the supply side? And if so, when might that begin to matter?
Okay, the current order book to fleet ratio by number of ships for vessels with a carrying capacity of 10,000 or more is 15.7%, more than double the level of 2 years ago. New building contracts signed in 2025 were moderate and around 60% down compared to the same period in 2024. Now in 2026, we anticipate around 530 tankers being added to the active fleet, and this is the highest number of addition in at least the past 10 years. Most of deliveries will be in the MR2 sector, accounting for around 27%, while Aframax, Suezmax, and VLCC sectors show a more moderate pictures with shares of 14%, 8%, and 7% respectively out of total 2026 deliveries. By 2028, we are looking around 1,030 tankers that will be 25 years old or older, while around 1,200 tankers are expected to join the fleet. On paper, that may look like growth, but it only works if demolition stays low, and that seems unlikely. Older ships face tougher vetting, higher fuel and maintenance costs, and tighter regulations, so they naturally struggle to stay in the mainstream market. On top of that, we have roughly 1,000 tankers currently sitting in the sanctioned grey fleet, and many of them old and in poor condition. Even if sanction ease, most of these vessels cannot return to normal trading because they lack proper class, insurance, and maintenance. So realistically, most older ships will either remain in gray trades or go to recycling. This means the new building coming by 2028 are mainly replacing aging vessels rather than adding real net capacity.
Thanks, Eirini. Mary, turning to geopolitics. Sanctions continue to reshape trade flows across the tanker market. How do you see these sanctions influencing freight rates today, and what might the impact be as we move into 2026?
Before I answer that, just in terms of checking in on how the larger crude tanker segment looks right now, 17% of VLCCs are under sanctions, 18% of Suezmaxes, and about 26% of Aframaxes and LR2s. So that's a significant section of the active fleet. So from the supply side, what that does is then tighten the availability for the compliant fleet in other markets. And then you balance that as well on top of a market that has had very low deliveries and new capacity added. So we have tightness on the compliant supply side just because of sanctions. And then on the demand side, we've had, a lot of lengthening of supply chains. So for some of the reasons we discussed earlier and some of the other questions, but also just the change in trade flows because of the Russia-Ukraine war. You had Russian crude oil and refined products not go to its more natural home in Europe, instead go further east. And then in turn, Europe had to, import oil from elsewhere, much further away. And then you add onto that the Houthi attacks, which had basically all but closed the Suez Canal, and you've had very long voyages that have had to reroute around the Cape of Good Hope. So from the demand side as well, you have a very inefficient situation, very high ton miles. So that's all the background. All of that's keeping freight rates high anyway. And then you add into this an administration in the US that is signaling that it will continue to put pressure on Iran under its maximum pressure campaign. So far, that's taken the effect, the shape of basically designating a new round of vessels almost each month. You've had continual sanctions this year on vessels trading in Russia from the EU and the UK specifically, and now the action by the Trump administration to sanction Rosneft and Lukoil as producers of Russian oil, which basically means that most Russian barrels are now under sanctions. So that really tightens the number of vessels that are actually going to be able to facilitate Russian oil. So all of that, a very large share of the active fleet already under sanctions, high ton miles, and all signals that basically these sanctions are going to continue, especially to bring Putin to the negotiating table, which is happening. That just leads to a more and more inefficient kind of shadow oil trade from Iran, Russia, and Venezuela. You have one outlet almost where these vessels can go, which is the Shandong independent refining sector in China. And to do that, that's a very inefficient supply chain that involves usually multiple STSs, a need to find vessels that are not sanctioned that can call in the actual port in Shandong. And with this appetite from governments to continue sanctioning vessels, there's going to be this continual need for new vessels to come into that dark fleet. So all of that should, just as a base case, serve to tighten the compliant market, just because that dark fleet will need to renew itself. Now, adding in a further complication on the Russia side, which is that now that so much Russian oil is under sanctions, the price cap mechanism, which enabled European-linked vessels to still carry Russian oil under that price cap, is basically kind of a moot point at this point. So that means that Russia has essentially lost about 26% of the vessels that carried its crude when it no longer has that option to use European-linked ships. So there will be then more need for vessels from that respect as well. Now, how this can then look next year, we don't necessarily know, even though the peace talks are ongoing, whether there's going to be really any kind of resolution made anytime soon. But if we did see any kind of peace agreed, we don't think that that would be, a very quick return of Russian barrels into the European market. But if that did happen, even if it happened slowly, that would be negative ton miles. But it's still not necessarily going to hurt the tanker market to the extent you might think, because that would then shift demand onto younger and more compliant vessels. And there wouldn't necessarily be this need anymore for the dark fleet vessels that have been facilitating a lot of this trade thus far.
Thank you, Mary. That was very insightful. I finally turn to Ioannis. Ioannis, where do you see the strongest employment opportunities for VLCCs at the moment? In your view, how does the OPEC plus supply picture compare with the growing pull from Latin America, especially given China's demand dynamics?
Thank you, Thano. So I think currently in such a high export environment with these tight constraints on vessel capacity, I think employment opportunities are strong everywhere. But looking ahead, no, I think first of all, it's important to note that this increasing supplies that we're seeing is not 100% a function of a response of demand. And, like when looking also at our import data as an indicator for demand, we're seeing indications of a relatively flat demand. And we're also seeing that marginal oil barrels are replaced increasingly by gas. So in this environment, and again, revisiting a previous comment, I think discharge, as these discharge delays and wind, and then inventories are starting also to rebuild. Exporters, and especially in OPEC, so talking a bit about the OPEC members, may take a more cautious stance. We have already seen OPEC announcing an halt to production increases for the first quarter of 2026. And if we use also history as a guide, OPEC can adjust quickly and is more comfortable in changing course month to month in order to be able to manage these prices. So I think a pullback from current levels, especially from the leader of OPEC, so around Middle East, UAE, Saudi Arabia, a cut of exports, a pullback of exports wouldn't be so surprising if inventories rise and crude prices soften. Now, shifting gears and looking at Latin America, we're seeing quite a different story there. So the region is leading off non-OPEC supply growth, as Mette said earlier on, adding roughly 2 million barrels per day since 2022. And looking at this from a VLCC terms, that's equivalent to about 30 extra loadings every month. And the momentum is actually still building. So looking at Brazil, is on track of adding around 500,000 barrels per day of new capacity 2026. Guyana will contribute another 250,000. And also Argentina is bringing in new VLCC capable terminals into the mix. So this is happening at a time where refining capacity in the Atlantic Basin is shrinking. Hence, this crude, as it cannot be absorbed from the Atlantic Basin, will have to travel further, creating these steady long-haul employment opportunities for VLCCs. And now this actually intersects with China's demand dynamics. So for China's state-owned refineries, OPEC Plus suppliers, and Latin America producers, specifically Brazil, remain the main suppliers of term contracts. However, when we look at this incremental or spot demand, especially as China brings this new storage capacity online, China's marginal barrels are likely to come from Latin America, especially if OPEC slows exports to manage prices. So to summarize, looking ahead, when we talk about the strongest deployment opportunities, the answer is, like more globally, more broad today. But looking ahead, I think Latin America stands out as the region with increasing opportunities when compared to this year.
Thank you, Ioannis. And this concludes our second round of questions. Now for the end, I kept our traditional question on outlook. So here it goes. Freight futures for VLCCs on the benchmark route from the Middle East Gulf to China are currently pricing 2026 at about 55,000 USD per day for the standard type of ship. Do you think spot freight rates will exceed these futures market expectations next year? Let me go around and ask you for a rough number, but also what could surprise us to either the upside or the downside. I start with you, Ioannis.
Thank you, Thano. I would say that the spot market has a solid chance of averaging above this level. While these extraordinary factors that we discussed earlier on will ease, the market still supports rates. We're seeing this steady, consistent long-haul demand, the possibility of old and poorly maintained sanctioned vessels heading to the scrapyard, as Mary alluded to earlier on, and a relatively limited amount of new builds coming in from long-term historical levels. Hence, I'd expect rates around 60 to 65,000 per day if I have to give a number for next year. What could surprise us? I think a key swing factor is, like how India and China will behave with purchasing Russia crude. If they keep buying Russian barrels, I would say, at a similar level with early 2025, then mainstream VLCC demand could shift to Aframax and Suezmaxes operating in the dark fleet. But if these buyers return consistently to mainstream grades, then VLCCs will likely benefit increasingly. And that's why I think any progress in peace talks, an easing of sanctions would likely reduce Russian purchase over time as, like these discounts wither away, which would be very supportive for the mainstream VLCC market.
Thanks, Ioannis. Mary, 55 USD per day for VLCCs for 2026.
So with this question, it is putting it, what we think here is a bit of a punt, because really what happens next year depends on two men, right? Vladimir Putin and Donald Trump, really, in terms of how the market shapes out, maybe sanctions, tariffs, a lot of different things. So there's a lot of ways next year could unfold. There's quite a lot of bearish factors, quite a lot of bullish factors. We can really see both ways. What we're seeing today on Cal 26 is trading just under about 52,600. So putting that into context, we within our modeling would kind of expect in all the different scenarios on average VLCC earnings to be at about 55K next year. So that is about 40% higher than average VLCC earnings in all of 2024. So the market does look strong next year. There would be, a loss of kind of total ton miles if we do see Russian oil return to the European market, but there's continued signals that there's going to be pressure on Iran, which does usually pull more VLCCs into the dark fleet. There's also the situation where, as we're seeing now, if India continues to really shy away from Russian crude, whether that's because of continued pressure from the US or threat of secondary sanctions if the war continues, or if Russian oil kind of eventually returned to the European market, that would benefit VLCCs because India would then turn towards either the Middle East or the Atlantic to replace those barrels. And again, just with these changes in refining capacity, being more east of Suez, more capacity coming on there, but then the growth in terms of production of crude oil really coming out of the Americas, as Ioannis also said, that will just send more barrels long haul, which will provide a significant upside for VLCCs in our view. So we're quite positive about the sector, and 55K seems like a good number for us, but also we're analysts as well, so not traders. So
you're excellent on explaining us next year why it was not 55K at the end of the day. Anyhow, Eirini, 55K for VLCCs for next year. Thank you, Mary.
Okay. As we move into 2026, the outlook for VLCCs still looks positive. Global gross domestic product is expected to stay steady, and the IEA sees solid growth in both oil demand and supply next year. If the same factors that boosted earnings in 2025 remain in place, then we could see another constructive year. Fleet growth is limited at roughly 3%, with 34 units deliveries expected, while around 60 vessels will be 25 years old or older. Effective supply is even tighter, as we said earlier, as many VLCCs remain tied up, moving sanctioned crude, mainly Iranian barrels, keeping them out of the mainstream market. Ton miles should stay strong as trade patterns are still shifting, and a big part of that is the replacement of Russia crude with long-haul barrels from the US Gulf and the Middle East. Moreover, the IEA expected significant oil surplus entering 2026, potentially nearing 5 million barrels per day if non-OPEC growth continues and OPEC Plus does not cut output further, which could increase floating storage and stockpiling, a bullish setup for VLCCs. Overall, the combination of tight effective supply and solid ton-mile demand should keep the VLCC rates at healthy levels, way stronger than 5-year average, and with room for short periods of upside if winter condition or routings add pressure. So yes, I think that 55 is a very possible scenario.
Thanks, Eirini. Okay, that was great. I would like to thank all our panelists for being here and sharing their views. It was indeed a very interesting discussion and hopefully an informative one that provided some food for thought on the outlook for the tankers market. And with that, we'll turn it now back to John in New York. John?
Well, another optimistic panel. I guess that makes it 2 for the day. And we exit the year for both dry bulk and tankers at very strong levels. And I guess anonymously was like, a very optimistic outlook for 2026. So thank you, Thanos, and thank you, our panelists, for their views on the tanker market. And that was our last panel of the day. I would like to thank all our panelists that made this event possible. We hope you enjoy the discussions and are a bit wiser on those very important industries when it comes to the global economy. So that concludes our Breakwave Day. Thank you all for joining us. We wish you all the best for the new year and looking forward to continue the discussion for the years to come. Enjoy the rest of your day.